Let's talk about the state of America in 2026. The Federal Reserve is holding the federal funds rate in a range between 3.5 and 3.75%. Inflation last clocked in around 2.7%. Groceries cost more, rent costs more, your morning coffee costs more, and the dollar sitting in your checking account? It is quietly losing purchasing power every single month. There is an old saying on Wall Street, cash is trash. It does not mean money is worthless. It means that holding cash, doing nothing, is a slow leak. If you are earning 0% on your money, while prices climb 3% a year, you are getting poorer in your sleep. Uncle Sam is not going to fix that for you. Your employer is not going to fix that for you. The only person who can fix that is you. And the way you fix it is by investing. But before you open a single brokerage app, we need to clear up the biggest myth in personal finance. When most Americans hear the word investing, they picture a sweaty guy on a trading floor, screaming into a phone, day trading meme stocks. They picture options. They picture crypto pumps. They picture losing everything. That is not investing. That is gambling. Real investing is something much more boring and much more powerful. Investing is buying productive assets. It is owning a tiny slice of a real business that wakes up every morning, produces something the world wants, and sends a piece of its profits back to you. When you own a share of Apple, you own a sliver of every iPhone sold. When you own the S&P 500, you own a sliver of the 500 largest companies in America. You are not betting, you are partnering. So forget Wall Street's casino. We are building a system, and it starts with the foundation. Before you invest a single dollar in the stock market, you need an emergency fund. This is non-negotiable. The rule of thumb is 3 to 6 months of essential expenses, sitting in cash, ready for a job loss, a medical bill, or a busted transmission. But you do not park that cash in a regular bank. The big four banks are paying around 0.01% on savings, which is a slap in the face. Instead, you open a high-yield savings account. In May of 2026, the top online HYSAs are paying between 4 and 4.25%. That means $10,000 in cash earns you about $420 a year, just for sitting there. It is FDIC, insured up to $250,000. It is safe, it is liquid, and it is the bedrock everything else gets built on. Once that fund is full, we move to the engine. This is where 90% of Americans leave money on the table. The US tax code gives you 2 superpowers, and most people never use them. Superpower number 1, the 401k. This is a retirement account offered through your employer. In 2026, you can contribute up to $24,500 of your own pre-tax income. That means every dollar you put in lowers your taxable income today. But here is the real magic, the employer match. Most American companies will match a percentage of what you contribute, typically 3 to 6% of your salary. If your employer offers a match and you are not contributing enough to capture it, you are turning down a 100% guaranteed return. That is free money. There is no other deal like it in finance. Always get the full match. Superpower number 2, the Roth IRA. This is an individual retirement account that you open yourself. In 2026, you can contribute up to $7,500 a year. You pay your taxes on that money now, but every dollar of growth and every dollar you withdraw in retirement is 100% tax-free, forever. If you invest $7,000 a year for 30 years and it grows to $700,000, you owe Uncle Sam zero. The Roth is the most powerful wealth-building account the IRS has ever created. The order of operations is simple. 401k up to the match. Then max your Roth IRA, then go back and fill up the 401k. Now, inside those accounts, what do you actually buy? Most beginners think they need to pick the next Amazon or the next Nvidia. They do not. Picking individual stocks is hard. Professional fund managers with Harvard degrees and Bloomberg terminals lose to the market roughly 80% of the time over 20 years. If they cannot do it, neither can you. So you buy an ETF, an exchange-traded fund, specifically an index fund ETF. The two you need to know are VOO, which tracks the S&P 500, and VTI, which tracks the entire U.S. stock market, all 4,000 companies. With one purchase, you own a piece of Apple, Microsoft, Google, Coca-Cola, Johnson & Johnson, and hundreds of others. If one company collapses, the other 499 carry you. Owning 500 companies is dramatically safer than owning one. The kicker? The expense ratio, which is the fee, on VOO is 0.03%. On a $10,000 investment, that is $3 a year. 3. To buy those ETFs, you need a broker. In 2026, the big three are Fidelity, Charles Schwab, and Vanguard. All three offer zero-fee trading on U.S. stocks and ETFs. All three offer fractional shares, meaning you do not need $500 to buy one share of VOO. You can buy $10 of it or $1. The barrier to entry is gone. Pick one, open the account online in 15 minutes, and link your bank. Let's get concrete. Say you can invest $500 a month. Here is a beginner-friendly split. 80% into a U.S. total market ETF, which is $400 into VTI or VOO, and 20% into an international ETF like VXUS, which is $100. That gives you exposure to America's growth engine, plus a hedge against the rest of the world. Now automate it. Set up an automatic transfer on payday. You do not think. You do not check the news. You just buy, every single month. Through the highs, through the lows, through the headlines, screaming the end of the world. This is called dollar cost averaging, and it is how regular people become millionaires. Here is the part nobody tells you. The market will crash. It always does. 2008, 2020. It will happen again. And when it does, your portfolio might drop 30 or 40% in a matter of weeks. Your stomach will turn. Your brain will scream, sell. Do not sell. Here is the 20-year rule of the S&P 500. In the entire history of the American stock market, there has never been a 20-year period where a diversified investor lost money. Not the Great Depression, not the dot-com bust, not the global financial crisis. Time in the market beats timing the market. Every single time. Let me leave you with the math that should keep you up at night, in a good way. If a 25-year-old invests $500 a month into VOO, and the market averages its historical 10% return, by age 65, they will have $1,620,000. They will have contributed $240,000 of their own money. The other $1,380,000, that is compound interest. That is the snowball. The single most important variable in that equation is not how much you invest. It is when you start. The best day to start was 20 years ago. The second best day is today. Welcome to the team. If you learned something, like and hit subscribe. I'll see you in the next one.